Hello, everybody. This is Xavier Clark, mortgage originator extraordinaire here in Augusta, Georgia. And I just want to make a quick video for everyone out there, especially for first-time home buyers. We're going to talk really quickly about what goes into a mortgage payment, because many people, and again, a lot of first-time home buyers especially, they don't realize that there are actually several things that do go into the payment, as you can see. Sometimes maybe they're looking on Zillow, or they download a loan calculator. They find themselves interested in buying a house. They get this loan calculator, and then they kind of just stop at the loan and don't realize there may be escrow or potentially even mortgage insurance associated with that loan. Okay, so again, principal and interest is what most people think of. Principal is the loan amount, so not the sales price, but the amount of money that you borrow. So if you buy a $300,000 house, you put $100,000 down. Your principal or loan amount will be $200,000. Okay, that's the principal. The interest rate is essentially the cost of the money, or the price of the money, the cost of your loan, so to speak. And I would encourage you to watch my video. I kind of talked to you about how this works. But if you have a fixed loan, then this number will never change. The principal and interest, it'll stay the same throughout the course of the loan. But the ratio of where the allocation of that payment to principal and interest will change as time goes on. Specifically, in the beginning, you'll pay more interest, and then eventually you'll pay more principal. Okay, so the next thing, and again, for a lot of people, that's sort of where the thought ends, but escrow is very important. And, a lot of people kind of get tripped up, or, kind of get a little confused on escrow, because they didn't even know they had to pay property taxes and insurance in the first place. So it's partially news that they even have to, when you buy a house, you have to pay property taxes and you have to have insurance, especially if you use a loan. Now, if you don't have a loan, you don't have to have insurance. But whether or not you buy straight cash or not, you've got to have, you're going to have to pay your property taxes. Whether it's land or a house, you pay property taxes. Okay, that's set by the government. Usually the local government will determine what your property taxes are, and that's public record, so you can look these things up. But again, you got to pay taxes. Now, insurance is just like any insurance; it's protection. And for a house, homeowners insurance, it'll protect you against a fire or tornado, or different what are called perils, which are outlined by the policy. And some policies cover more things, some cover less. Flood insurance is kind of its own thing, but if you're not in a flood zone, you can usually get flood insurance pretty cheap. But if you are in a flood zone, it gets set by FEMA, and you have to get that. But again, insurance protects you against the house. So if something happens, just like if you crash your car, insurance will repair the car, or pay to repair the car or fix it. If something happens to your house, you got to repair the roof potentially, or something burns, insurance will step in and repair the house, which is called indemnification. It restores you to where you were before. On a side note, homeowners insurance also can protect you against, if someone was to injure themselves on your property, it can protect against that. You can also protect you against theft and all kinds of other things. But in relation to a mortgage, we're talking about repairing damage to the house. And the reason to that is, the house is what's providing the collateral or the value of the loan. So lenders, want to make sure that stays intact. Okay, so escrow is very important. Now, if you put 20% down on a loan, you may be able to not have escrow. Different loans are different. Sometimes investments still require you to do it. Usually FHA requires you to have escrow no matter what. VA is usually the same. USDA the same. So a lot of government loans require escrow, but some other loans from different lenders may allow you to not have escrow. But an overwhelming majority of loans, you'll have your loan repayment and then escrow also. And so the way it works is your taxes and insurance are divided up equally. So for 12 months, so you divide that number by 12, and then each month you pay it. So December you pay it 12th, then January you pay it 12th, February you pay it 12th, until the bill comes due, and then your mortgage company will pay the bill for you. Well, not for you, but they'll take care of the payment, and you've already paid it. Okay. Now, MI, mortgage insurance, is, and there's really two kinds. If it's just MI, it's kind of semantical, if you will, but mortgage insurance, or just MI, is usually a government loan. It's a rate set by the government, meaning anybody who gets a certain type of loan will have that same rate. For instance, FHA or USDA, then everyone who has a USDA loan pays the same rate. Everyone who has the same FHA pays the same rate, basically. But if you have PMI, which is private mortgage insurance, that's actually a separate company. It's an independent third-party company that sells mortgage insurance, private mortgage insurance. And if you don't make your payment or default, they will step in and cover some of the loss to the lender. Okay, so monthly payment can oftentimes, and usually, I would even venture to say, includes all or most of these items. Okay, and again, if you put 20% down, you can avoid PMI. Again, there's several loans that do not have PMI, such as VA. Other loans don't. The company I work at has some loans that you can have no PMI without putting 20% down. Sometimes you can have the lender pay. But again, PMI, generally speaking, if you don't put 20% down, you have that. And escrow, your taxes and insurance, you always have those if you have a loan. But whether or not you have to pay them monthly or in one big bill when they're due varies with loans. But again, usually all of these are included. And again, mortgage insurance is kind of the wild card because you don't necessarily have that. So a quick example just to show how this all kind of works. And again, just an example. This is not your situation. This is not, your uncle's. It's just a completely theoretical situation, just to kind of illustrate how this all works. So again, $200,000 loan amount. Okay, not a purchase price, but $200,000 loan amount that they did not put 20% down on, as you'll see. But the loan amount is $200,000, and the interest rate, we've got 5% here. I mean, it's just a number between 0 and 10. But yeah, that's the rate. Property taxes are $2,400 a year. Again, just a number, just for the example. That's a good number because it's nice and clean, and it gives you $200 a month. And again, property taxes are public record. You can look those up. And for some places, this will seem like a high number. For some places, this will seem like such a low number. It just really depends. Again, just numbers for this example. And then homeowners insurance, we're going to put $1,200 a year because that comes out to $100 a month. And again, all these will vary on your situation, and they may vary drastically. But again, just to kind of show you how it works. So property taxes, $2,400 a year. You divide it by 12, that's $200. Homeowners insurance, $1,200 a year. Divided by 12 is $100. And then PMI, we're just going to say is $85 a month. And again, that's sort of the wild card. So you've got that monthly payment. Again, the fixed rate, fixed amount. So it's going to give you a fixed payment. You're going to have your taxes and insurance added to that. Again, a little bit that you pay each month, so that when the bill comes due, that money has been set aside in a separate account, your escrow account, and you pay that. And then if applicable, the wild card mortgage insurance, but in this case, we add it. So your payment would actually be $1,458.64 per month. So again, $1,458.64 per month. Whereas just the loan itself in this scenario is $1,073.64. So all the extras that are part of your loan payment or your mortgage payment, not your loan payment, but your mortgage payment, come out to be, they add close to $400 a month. So again, just a simple video to kind of, again, for people who may not be aware of this, or people who are kind of familiar, or even those who are familiar can see a breakdown. Again, this is just a theoretical example, but hopefully, it kind of breaks it down a little bit. Just to recap, principal and interest, that's the actual loan. Taxes, insurance. Taxes, you're always going to have. Insurance, you will almost always have with the loan. And you may or may not have to escrow that. Escrow means setting aside the money every month, not you personally, but your mortgage company, and then paying those bills as they come due. So they're set aside. If you do not escrow, you pay the bills yourself. And normally that comes with putting 20% down, but not in all cases. And then mortgage insurance, again, the wild card mortgage insurance. Again, normally 20% down. Other loans don't have to have it. VA, some other nichier products do not. But generally speaking, you may have it if you do not put 20% down. And certain government loans, you will have mortgage insurance no matter what you do. So hopefully, again, this is educational. Xavier Clark. If you have any questions, reach out to me, and we'll be glad to help you. Take care.